Scope's 2022 Sovereign Outlook, we outline a global economy continuing on a longer-standing baseline for uneven, although robust recovery, with growth globally of around 4.5% next year, after around 5.8% this year, presented in this diagram. GDP is seen continuing to grow above trend next year. 3.5% in the United States, 4.4% for the Euro area, 3.6% in Japan, 4.6% for the UK. Even if, in most cases, such above potential rates still reflect a degree of normalization from the very elevated early recovery growth rates of 2021. China is seen growing near a trend, 5.2% next year. We assume momentary slowdown over the current quarter and Q1 next year across many economies, if not, in some cases, a temporary output contraction, as countries of Europe reintroduce generally lighter restrictions on basis of renewed rising cases, including cases associated with a fresh Omicron variant. Over time, we continue to assume the severity of virus risk for economic recovery moderates as governments adopt more targeted responses during lockdown phases. Virus becomes more transmissible, but less lethal, and businesses and people adapt ways of doing business. As compared with a balanced skew to risk entering this year, we judge risk to the global outlook entering next year as being skewed on the downside. Since early on, when consensus was for rising inflation as being transitory, we disagreed and held the view there is a moderate structural component to current high inflation, with, in our opinion, inflation staying somewhat above pre-crisis averages, even after price changes begin to substantively moderate by next year. This is likely to trigger continued divergence of monetary policy. Inflation risk is especially pronounced as regards the United Kingdom and the US, where inflation may continue testing 2% price stability mandates. Inflation risk, much less the case in Japan, of course, with the ECB somewhere in between, with inflation potentially remaining under 2% longer term. By the end of 2022, policy rates of G4 central banks are expected to similarly diverge, as displayed here, with the ECB and the Bank of Japan remaining on hold, but rate hikes expected from the Bank of England and Federal Reserve. Intervention from central banks has cushioned sovereign credit ratings over this crisis. So any scenario of much more persistent inflation, limiting monetary space to intervene, is a risk affecting credit outlooks, with the possibility of crystallization in latent debt and financial bubble risks. Entering 2022, sovereign borrowers with a stable outlook make up presently over 90% of our publicly rated sovereign universe.